Hello students, here is the another video for your online class, and I welcome you again to your class 11th for the subject accountancy. Well, today we will be learning double entry system. Now what is double entry system? Meaning of double entry system. According to this system, every business transactions affects at least two accounts in opposite directions. For example, if the machinery is purchased in business, machinery is increased and cash is decreased. So in accounting, double entry system means that every business transaction that you deal with has at least two accounts which will be affected and both will move in the opposite direction. Suppose purchased a machine for cash. So two accounts are affected. Machine that you have purchased is increasing and cash that you have to pay from your business is decreasing, and both are in the opposite direction. There can be no account which affects only one account or which has only one aspect. So there is no business transaction and there is no such accounting record that we can do that will have only one account which will be affected or only one aspect. It means that at least two accounts are affected by a transaction, one account receiving a benefit and the other account yielding the benefit. So here at least two accounts will be affected. One account which is receiving the benefit and the other account which is yielding or giving the benefit. Okay, now listen very carefully. Ram received cash from Shyam. Okay, so here Ram is the receiver, so we will debit Ram because he is getting benefit, and here Shyam is the giver or is yielding the benefit, so this will be credited. So here at least two accounts are affected. One is receiving the benefit and the other is yielding the or giving the benefit. Further we will go with the classification of accounts. Based on that we will learn the rule of doing the journal entries, and this rule should be in your mind what we are going to learn, what we're going to learn a little while after in this video, that will be very much beneficial for you all to do any kind of journal entry. Definition. Let us look into the easy one. We have J.R. Bartley Boy's definition. Every business transaction has a twofold effect, and that it affects two accounts in opposite directions. And if a complete record were to be made of each such transactions, it would be necessary to debit one account and credit the other account. It is this recording of twofold effect of every transaction that has given rise to the term double entry system. So here J.R. Bartley Boy defines that every business transaction has a twofold or dual effect and at least affects two accounts moving in the opposite direction. One has to be debited and the other account has to be credited. Like previously I gave you the example of Ram receiving money from Shyam. So let us take the another example. Okay, machinery purchased for cash. So here machinery will be debited. We can say that it is increasing, and cash will be credited. We can say because this is decreasing. Opposite, machine will be debited because it is increasing and cash will be credited because it is decreasing. Okay, now since later on we will follow only one type of rule, So I will tell you the rule what we're supposed to follow. So we'll consider machine as what comes in. Okay, so what comes in will be debited, and we will consider cash as what goes out. Both we're considering as the real account. Cash is what goes out, and so it will be credited. So every business transaction has at least two accounts which will be affected in opposite direction. One will be debited and the other one will be credited. Next we will see principles or characteristics of double entry system. Double entry system is based upon the principle that every debit has a credit and every credit has a debit. So if there will be any debit, naturally it will have a credit, and if there is any credit, there will be always a debit. The first one is every business transactions affects two accounts, at least two accounts. Every business transaction has a twofold effect, that is, it affects two accounts simultaneously. One of them is debited and the other is credited. The amount of accounts to be debited and credited will be always equal. So here we have just learned earlier that if there is one account which will be debited, the other account will be credited, and both account will be debited and credited with a equal amount. Not that machine is purchased for 50,000 and the cash is credited for 20,000. No, it has to be same amount, equal amount debited and credited. Next we have recording of both personal and impersonal aspects. Both personal and impersonal aspects of a transaction are recorded in the double entry. It is possible that both aspects of a transaction may be personal or both may be impersonal, or one may be personal and the other may be impersonal. Now you're getting confused with personal and impersonal. Very soon we'll learn about this in the same video. Personal, now the account is been classified into two major: personal and impersonal. Personal are the accounts of the natural and the artificial human beings. Okay, like we have natural human beings, like we have Ram, Shyam, Rohan, Mohan, Geeta account, Neeta account, and artificial persons are like ABC Limited and Rohan and Sohan traders, any institutions account. Okay, and then impersonal accounts are the accounts which can real account which we can measure in terms of money. Okay, it can be a tangible which you can see, like we have building, furniture, or it can be intangible which you cannot see, like goodwill, copyright. So here it says that when we do a double entry, two accounts will be affected. Either both may be personal, like we had the example, Ram received cash from Shyam, so both were personal, or both may be impersonal, like machinery purchased for cash, so machinery and cash both are impersonal, both are real account. Impersonal means something that is not related to any person thing, but you can measure in terms of money, or one can be personal and other can be impersonal. Okay. Next we have recording is made according to certain specified rule. Now when we do the journal entry, it is not simply we go on doing the journal entry. In double entry, one account is debited and other is credited. There is certain rules for debiting and crediting. The debits and credits are made on the basis of these rules, and very soon we will be learning about these rules, and based on the rules we have to debit the particular account and credit the particular account. Simply you cannot just make a choice and debit something and credit something. It has to be based on the rules. Preparation of trial balance. Since one account is debited and the other is credited, total of all debits is always equal to the total of all credits. This helps in finding out arithmetical accuracy of accounting records. This is done by preparing a trial balance. So here, to find out whether your journal of what you have done, the double entry system you have used for journalizing, you have debited one account and you have credited other account, and when you total all the debits, that will always equal to all the credits, and this we can find out whether you are arithmetically correct of recording your accounts or not by preparing a trial balance. Now let us look into all the principles and characteristics of double entry system that we saw just now. The first one was every business transaction affects at least two accounts. Second one, recording of both impersonal and personal aspects. This we are going to learn very soon. What is personal and impersonal aspects? Recording is made according to certain specified rules. These rules also we are going to learn very soon. Preparation of a trial balance. This you will learn only after you have learned how to record the journal entry, post in the ledger, and then only we will be able to learn how to prepare the trial balance. Classification of accounts. The account is classified into personal and impersonal, and further impersonal account is classified into real accounts and nominal accounts. Now what is personal accounts? The accounts which relate to an individual firm, company or an institution are called personal accounts. So it might be a name of an individual firm, company or any institution. For example, account of Sohan and Mahesh Traders, account of DCM Limited, accounts of Delhi University, bank account, capital account of the proprietor, businessman, drawings account of the proprietor. Now drawings account is made when personally a businessman from the business for personal use withdraws money or goods from the business. What is the object? Object of preparing a personal account is to ascertain as to how much amount a personal account owes to the business, that is, and how much amount is owed to the personal account from the business. So here the object of maintaining a personal account is to know how much amount of money that particular person, individual or a firm is supposed to pay to your business, or how much your business is supposed to pay to that person, individual or institution or firm. So this is the object of preparing a personal account. The rule: debit the receiver and credit the giver. So in personal account, the person or the individual or institution or firm, whoever is receiving, will be debited, and the person who is giving will be credited. The receiver will be debited and the giver will be credited. Now let us look into the types or classifications of personal accounts. The first one we have here is natural personal accounts. The accounts of human beings, for example, Sohan's account, proprietor's capital account, debtors and creditors account. Now, in debtors account, we write the names of all the person to whom we have sold goods on credit and later they will pay money. And in creditors account, we write the name of all those person from whom we have purchased goods on credit and we will pay them later on. Artificial personal accounts. They do not have physical existence but works as personal account. For example, firm's account, any limited account, any institution account. So they are not like they are really do not have any kind of existence, we can say, like a human being, but they work as a personal account, like account of a school or account of a college or account of a hospital or any company. Representative personal accounts represents a particular person or group of persons. For example, salaries outstanding account, prepaid insurance account, unearned commission account. Here, this particular account, like salary outstanding account, okay, we have some amount of salary which is supposed to be paid but has not been paid to the workers. So it is representing a person or a group of persons to whom the salary is still not been paid. Or prepaid insurance account, it represents a particular person or a group to whom we have already paid the insurance amount. Okay, so here maybe there might be 100 workers and 200 workers, maybe to some workers who are supposed to receive some amount of salary that is remaining outstanding. So we are representing that particular group of persons are supposed to receive the salaries as outstanding account. Okay, so here the personal account can be natural, like human beings whom we can see, with whom we can talk, or it can be artificial personal account like institution, firm, college, or it can be representative personal account. An account is made to represent a certain group of person who are supposed to receive some amount that they have not received, or they have already paid some amount in advance which they were supposed to pay on a particular date, but they have paid on advance. So all this will come under the representative personal accounts. Real accounts. These accounts of all those things whose value can be measured in terms of money and which are properties of business are termed as real accounts. So real accounts is something you can measure in terms of money, and these are not simply somebody else things you measure in terms of money. This should be the property of the business. For example, cash account, furniture account, machinery account. So cash, furniture and machinery are tangible, which you can touch and see. There are some real accounts which are intangible, like goodwill, patent, which you cannot see, but you can value it or you can measure it in terms of money. So goodwill, like how much is the goodwill in your market? You can measure it in terms of money. When somebody wants to join as a partner, You can ask the partner for the goodwill amount depending on what is the value of your company. Patent account, like you have made some kind of you have invented something and then you get a patent account. So that patent account is a right for you to earn money, which you can measure in terms of money, but you cannot see that in reality. Objects. These accounts represent the value of various properties owned by a business in terms of money and indicate the financial position of the business. So the object of the real account is to represent the value of various properties that you have in your business and you can measure in terms of money, and to find out what is the financial position of your business. So the rule is debit what comes in and credit what goes out. So in real account are those which we can measure in terms of money. So what comes in will be debited and what goes out will be credited. Now let us look into the types or classifications of real accounts. Tangible real accounts. The accounts of those things which can be touched, felt, measured, purchased, sold, etc. So tangible means something which we can touch, feel. Example, cash account, stock, furniture, building, land, machinery. The second type is your intangible real account. These accounts represent such things which cannot be touched, but of course their value can be measured. For example, goodwill account, patent, trademarks account, copyright account. So these are the intangible objects which we cannot touch or see, but it has a value. It can be measured in terms of value. When you have invented something, you can take a patent of that product and a right to sell your own the right of owing that product as a founder of that product, or a copyright, or if you have got a brand mark or trademark. So all these are intangible real account which cannot be touched, but it can be measured in terms of money. Next we have is nominal accounts. The accounts include the accounts of all expenses and incomes. The examples of nominal account relating to expense are salary paid, rent paid, bad debts, discount allowed, etc. So here nominal account includes of expenses and income. Expenses like salary paid, rent paid, commission paid, bonus paid, bad debts. Bad debts is also your expense, because bad debts is considered when your customer is not paying you money, so that is your expense. Discount allowed, when you allow discount on your product, that is also your expense. The examples of nominal accounts relating to incomes are commission received, interest received, discount received, etc. So when you receive, it becomes your income. Either it is a commission or interest or discount. Objects. Nominal accounts are those accounts which are in name only and which do not really exist. These are opened simply to explain the nature of head for cash has been paid. So nominal account is just a name, and in reality it doesn't exist. It is simply to tell that where you have paid money or from where you have received money. Rules. Debit all the expenses and losses and credit all the income, gains and profit. So all the expenses like salary paid, rent paid will be debited, and all the incomes and gains like discount received, interest received will be credited. Very soon we will be learning the journal entries, and thank you for watching.